So let's get started. We're going to talk about Life Insurance 101, everything you need to know. Quick disclaimer, anything we talk about today is not personal financial advice. Don't go ahead and do exactly what we say off the back of this webinar and then blame us if anything goes wrong. So we'll start off, we'll talk about the agenda. So we're going to talk about the 5 main types of insurance cover. Second thing we'll touch on is how can you get insurance? So what are the different options of actually obtaining the cover? How much insurance do you need? We'll talk about premiums. We'll talk about like the application process, what underwriting means and what it is. And then once you've got the cover in place, how do you go about changing that cover? And then most importantly, hope you never need this, but the 7th thing on the agenda is how to make a claim. So what that process looks like. And then, what do you actually need to do to prepare to see a financial advisor and where to go from here? And then question and answer. The most value people get out of these webinars is the Q&A. So definitely, put down as many questions all throughout the presentation. Just write any questions. We'll get to it towards the end. So to kick off, really, what's the point of insurance? Everyone has a plan until they get punched in the face, as the great Mike Tyson says. So insurance, hopefully it's a complete and utter waste of money. That's the ideal. But everyone has plans to grow their wealth and to do really well financially. But all of that turns to nothing if you get punched in the face. So that's really the purpose of insurance, is to protect that. If something really bad was to happen, either mildly bad or catastrophic, you've got some money there as a backstop. So to start off, Azaria, you're going to go through the 5 types of insurance cover.
Definitely. So number 1, you've got life insurance. So most people have heard of life cover. It's pretty straightforward. This policy pays you out a lump sum of money if you were to either pass away or be diagnosed as terminally ill. So that's the insurance that pretty much everybody knows and understands. And then we've got total and permanent disability insurance. So you may hear this one referred to as TPD cover. Now, this one pays out a lump sum of money as well. This one's under the condition that you are totally and permanently disabled and unable to work again. So, of course, this is less likely to happen, but if it does happen, probably the most expensive thing that could ever happen to anybody. So you've normally got quite a bit of cover for this policy. We've then got income protection insurance. So this is another policy that we get a lot of people coming to us for. And this policy pays you a monthly payment if you're off work due to either illness or injury. So if you can't work, what this policy does is it can pay you up to 70% of your income each month. Every income protection policy comes with a waiting period. So that's the length of time you'd need to be off work before you start to receive that income from the policy. And then each policy also has a benefit period, and that's how long you can be on the claim for. So if you've got cover in your super, it might have a 2-year or a 5-year benefit, or you might even have a policy that can pay all the way through to age 65. So there's some really long-term income protection policies out there as well. And income protection is the most likely to be claimed on. So plenty of us in our working life will need to take some time off work for health at some point. Then we have trauma insurance. So not as many people know about this policy, but it's a really, really important one. And it's another one that we see a lot of claims for. So this one also pays out a lump sum of money. The only requirement here is that you've been diagnosed with a serious illness, such as cancer, heart attack, or stroke. So we've all known someone who's been touched by one of those illnesses. That's where trauma insurance comes into play. It doesn't require you to be off work. The only condition is that you've been diagnosed. So again, another one that we see a lot of claims for. And then the final one that we've got here is child's cover, so also known as child trauma. So just like what we talked about with trauma for adults, covering for serious illnesses, there's also a policy that covers your children as well, if anything were to happen. So this one pays out a lump sum of money if they're diagnosed with a serious illness such as cancer, if they lose their hearing, if they suffer a neurological condition. That just gives you that financial relief to maybe take some time off work and cover any expenses that might come with a diagnosis like that. So 5 different types of cover. What you need depends on your situation, but we'll go into a bit more of that in just a moment.
All right, next we are going to talk about how to get life insurance. And when we say life insurance, we might talk about like life insurance a lot. We don't mean just the death cover. We mean all of these 5 types of covers. So there's kind of 3 main ways of obtaining the cover. Or 3 different types of cover. So group cover, direct cover and retail cover. So we'll talk about the pros and cons, and I'll just explain what they are as well. So group cover is where a superannuation fund or an employer or even like sporting groups will have a group cover. And how it's set up is there's generally like a set formula in terms of the level of cover and how it works. So for super funds, they'll often have, based on your age, how much cover you'll get. As you get older, that level of cover will come down. With employers, it may be based on your income. And so it's different kind of, whoever the group is who sets it up will formulate that formula. Now, the best thing about the group cover is it's often automatic. As soon as you join that group at that employer or that super fund, you'll often get it as an automatic cover, automatic acceptance. The other thing is some pre-existing health issues can automatically be covered under that policy. You need to get into the nitty-gritty of the policy to read if it does or if it doesn't. So if you've had a history of a back injury and you join that group, they may not have a clause in there that excludes any pre-existing health injuries. So it's really good for that default level of cover. Now, some of the downsides of the group policies is it can change without you'll know about it. You'll get told about it if you read your statements from your super fund, which none of us do. So you will get told about it, but you can't change it. So if they make a change that says, hey, we're not going to pay income protection at the same time as a disability payment, if you're eligible for a disability payment, which one of the major super funds in Australia did recently, then that's the rule. Under any future claims, that's the new rule that happens. So it can change over time. If you're looking at increasing the cover, it can be a bit more complicated in terms of they may not put exclusions on the policy. They may just straight out decline that increase. But different groups will have different requirements around that. And the premiums tend to increase as you get older, which a lot of insurance policies do. And sometimes, or quite often, especially within super funds, the level of cover decreases. So as you go from 35 to 36, well, you may have 20% less insurance cover. So if you claim at 36, well, you've got less cover at claim time. So the other one is direct insurance. So it's generally sold either, when you're setting up a mortgage with a mortgage broker, they might set up some insurance directly with the insurer. You can go directly to the insurer, and it can be sold via like TV. So, if you're sick at home watching TV during the day, you'll see plenty of ads about life insurance that you don't need to go through medicals. And so while some bigger insurance companies offer insurance policies direct, a lot of it is often sold through intermediaries. And so the pros is you go direct to the insurer, the cover can be fast, especially if they say there's no medical requirements. The catch is that, and the downside of that is that they may require medical underwriting at the time of claim. So they'll say you don't need medicals at the time you apply for the cover, you pay your premiums for the next 20 years, then you go to claim and they'll say, well, we've got a clause in the contract that says that we're not paying out on pre-existing medical conditions. And so, at claim time, you may get stung by it. Often limited options with income protection. So, the biggest insurance company in Australia, they often will only sell a income protection benefit period of 5 years if you're going to them direct. But if you go through an advisor or even through super funds or group cover, you can have longer periods of income protection benefits. And limited options to pay the premium. So we're going to talk about premiums, but if you go direct to the insurance company, I don't know any insurance company that you go direct in the market today that allows you to pay some of the premiums through your super fund. So it's all paid personally. So whether you have life insurance, disability, income protection, whatever it is, it all has to be paid personally. And then there's retail insurance, where it's sold through a financial advisor. So they're individual policies, medically underwritten, which we will touch on what that means. The terms can't be altered the insurance company can't alter the terms. So what that means is they set up a contract. You set up a contract with the insurance company directly, and under contract law in Australia, one party can't amend the contract without the consent of the other party. And so whatever the contract is that you set up at the time, that's what it is at claim time. So there's no kind of surprises at claim time that, the policy's changed. So the pros, it's fully medically underwritten. So which means that insurance companies do a lot of work up front to make sure that they're comfortable with the risk that they're taking, insuring you, because they can't amend the contract or change it. They do a lot of that research up front. Speed and certainty at claim time. So you'll generally, if you have exclusions or loadings, you'll know that up front and while you hold the policy. So at claim time, if you try and claim on a back, but you got a back exclusion, there's no argy-bargy, no fighting. They won't pay out a claim. But it also means that if you have a back issue and it happened after the policy was set up, then it's pretty straightforward in terms of claims. The policies are guaranteed to renew each year. So what that means is that it can't just be cancelled in the future. So under the Life Insurance Act, the life insurance contract cannot be cancelled. So if you go on claim for 5 years for income protection, then you go back to work, the insurance company can never cancel that policy on you. So they have to guarantee it. So if you go back on claim in the future again, well, they're going to honour that policy. You're fully covered for accidents and illnesses worldwide. So you go traveling overseas, you're still covered under the policy as well. And it can be funded through your super fund and paid personally. So you can maximize the tax efficiencies of holding the policies. What is often a misconception is it's a lot of people think it's more expensive, but these days it's actually quite often cheaper than getting it directly through the insurance company, even for the exact same policy, or going through the group cover. So our last webinar, we did a lot of analysis on pricing, and majority of the time in our business, we look at if we ever replace a policy, it's almost always cheaper to replace with a retail policy than the group cover. But not all the time, and I'm not going to promise it's going to be cheaper. You can't do that. Some of the cons is if you have health issues, the application process may take longer. As I said, the insurance company does a lot of research up front to determine the risk that they're willing to take on to insure you. So it does take a bit longer. And you may be asked, if you're getting large levels of cover, you may have what's called mandatory medical assessment. So they may ask for blood tests, they may want other medical checks. Generally for our clients, it's rarely mandatory medical tests like blood tests, unless there's a pre-existing health issue that dictates the need for that. It's only for really large levels of cover that's generally the case. So next is how much insurance do you need? So I'm going to touch on this. So really picking the right amount of cover is a little bit difficult. There's no right answer and there's no wrong answer. One person's under insurance and, where they're not comfortable having that much cover, maybe another person's over insurance. I hear plenty of advisors talking to their 70, 80-year-old clients spending. I had a conversation last week, 70-year-old paying like 80 grand a year on a life insurance policy, which is mind boggling. And he didn't want to cancel. His theory is, I've got plenty of money. He's independently wealthy, but I've been paying these premiums for a long time. I'll just keep paying it. Even though the advisor was encouraging him to maybe cancel the policy because it's really expensive. So there's not any right or wrong answer. And it is much more complicated than just a set 10 times your income. So like Barefoot Investor talks a lot about, 10 or 15 times your income. We have a very different philosophy. And people often underestimate the value of their lifetime income. At the end of the day, insurance is really protecting your income and that loss of income if that was to happen. So, and just assessing what that loss of income actually looks like from a financial point of view, people often underestimate the actual cost of that. So we've got scenarios now. There's lots of numbers here. Like if I'm going to lose a few people here, go and watch the replay later because I'm not going to spend heaps of time delving deep. But we're trying to give you a rough idea of how we think about it here with a client scenario. So we've got two scenarios side by side, one with couple, one with singles. And I'm going to explain kind of the differences between them. But you can see the income, the couple, $100,000 income on 40-year-old, 45-year-old partner on $35,000 worth of income, homeowner $750,000 with kids, and then their super balance there. So they're kind of some of the metrics that of how we determine the level of cover. And one thing to note, this 35-year-old isn't working more than 15 hours a week. And the reason why that's important, I'll touch on a little bit later when it comes to income protection. So the single 30-year-old, 75 grand of income, no home loan yet, $50,000 in super. And we asked the question, and one of the questions we ask when we go through our process is, do you want money to buy a house if you could never work again? So you're totally and permanently disabled. Some people say no, some people say yes. At the end of the day, it's everyone's individual purpose. As I said, going back, one person's over insurance is another person's under insurance. So this person ticked yes, they want money should they be totally disabled. Now, life insurance, I'm going to go life, TBD, income protection, and trauma. So for the couple, we've got different sets of numbers. Now, the reason why this top number, replacement of income for this couple, is the same, even though one's earning $100,000 and another's earning 35 grand, is because the way we think about it is we want a minimum set of money if one person was to pass away. So for the person earning $100,000, we worked out the minimum is $60,000. And the reason we've got a minimum is because they've got kids. So when you've got kids, it's not just the loss of income that you need to protect, but it's also what are the extra costs involved with caring for those kids. So that's why a lot of time we do have a minimum of $60,000. We want to clear the debt, so there's no home loan. Some people think they may want to cover investment debt. That's not how we see the world. But if someone says that that's important to them, then we'll cover that as well. And then there is a small allocation for cost for funerals, and then we minus the super balance out of that. So basically, fancy way of getting to a number, and it's well thought through for that couple. And as you can see, the person who's earning less is actually requires slightly more money because the level of income replacement's the same, the debt's the same, but the super balance is different. Now, for the single, they don't have debt, they don't have dependents, they don't have a need for life insurance under this scenario. And so there's funeral costs, but their super balance will cover that cost. So there is no actual shortfall for insurance needs. For disability, and as I said, go and watch the replay because I am going to speed through this and I know it may be difficult to follow. For disability, one thing I've highlighted a few things here. I'll touch on the single because it'll be easier. We do allocate money for medical expenses. Now, if you're a quadriplegic, the lifetime cost of that is millions and millions of dollars. So we know we're going to underinsure for that. But if you can't ever work again for a mental health condition, the lifetime medical cost for that is much lower. So there is a big discrepancy on medical requirements, but we allocate $100,000. Again, some people want more, some people want less. And then we think about a lump sum to replace the difference between income protection and their income. So if there's income protection, that'll fund a big portion of that loss of income. So 70%. And so there is a shortfall there because income protection will never fully cover your income. And then for this single, even though they don't have debt, they articulated that they wanted money to buy a house if they could never work again. Because if you're on income protection claim and you can never work again, I don't know many banks who are going to offer you a home loan on that income protection claim because it's not guaranteed to continue. So that's why this person said, hey, I just want the money there available. So we build that into the disability portion. And there is tax. So that's one thing to note. There is tax. It's an assumed rate of tax that we've built in based on the current age and a whole bunch of other things. But we build that in because there's potentially tax on a disability. Now, for the couple, you can see that the lower income earner actually requires a higher level of income replacement. And that's because the lower income earner isn't able to get income protection. So we're actually got to replace a much higher amount. So for the higher income earner, we're replacing 30% of the income. For the lower income earner, we're replacing 100% of that income until retirement. And they were also younger as well. 5 years younger means you need a greater level of cover. So that's why we personally don't think about just doing X times income, because under this scenario for the couple, we would have $350,000 for the life and TBD for the lower income earner. When you've got $750,000 worth of debt and you've got kids running around needing to be looked after, $350,000 is completely underinsured in my mind. So next, it's trauma insurance. Again, our philosophy and the way we think about it is different for singles or couples, but we want to cover the difference between income protection and income. So 30% of your income for 12 months for the single, and then $100,000 for medical expenses. Again, a trauma payment will be different for different things. So you could have a heart attack, get rushed to hospital, and there may be no out-of-pocket cost because you're going into emergency, you're in hospital for 2-3 weeks, and then you're on bed rest for another month or two. There may be very little actual cost involved, but you can have a battle of cancer for multiple years, and it'll cost you significantly more. So we allocate $100,000 for that. And for couples, it's a little bit different because I know for me, if Kate was to have cancer, I'd be out of work, not because I can't work, but because I would choose to. I know that the kids need to be looked after. She needs a significant amount of support. So that's why for couples, we look at replacing the the spouse's income for 12 months, the after-tax income, plus $100,000, plus that income replacement. But if you can't get income protection, we allocate more money. So again, the lower income earner actually requires more insurance cover for this scenario. It's not always the case, but for this scenario, the way we see the world, there is a higher requirement for more insurance for that lower income earner. And then we include $100,000 for child's cover. Again, could be too much, could be not enough. This is income protection. I forgot to change this title. This is why you need to prepare more than 5 minutes before the webinar. So this one's income protection. And as I said, for the client one, $100,000 worth of income, we can replace 70% of that. But for the lower income earner, because they're working less than 15 hours a week, we can't actually obtain income protection. And then for the single, it's pretty straightforward, just a percentage of their income, 70% of their income paid on a monthly basis. So then the possible recommendation, this is where it also gets a little bit funky, and stick with me here. So we've kind of shown you what the life insurance, TBD, trauma, and child's cover, and income protection would look like for each of these people. So you can see for this single, we've actually recommended life insurance, even though if you go back, there's zero requirement for life insurance. The reason for that, because even if we don't think people need life insurance, sometimes we recommend it because it can be more cost effective to group it together. So it doesn't make any sense. You get life insurance for a cheaper overall premium, but that's how our insurance companies kind of group those policies together. So even though we don't think there may be a need, sometimes we recommend it still. And again, with this, with the couples, that life insurance for the higher income earner, having life insurance at a lower level made it cheaper. So we did what we think was required. But for the lower income earner, it was just priced differently or priced better to actually increase that life insurance portion. So again, it's not just a matter of going, let's just pick a number of X times income. It's a matter of going, well, what cover can we get? Because that'll determine the level of cover. If we can't get income protection, well, we need more disability cover. If we can't get trauma cover, well, maybe we need to boost up the other covers a little bit. And it's also pricing as well. If it's actually cheaper to have life insurance, even though I don't need it, well, you may as well have it. So that's why, how much cover to get isn't as simple as X times X and plus a mortgage. It is a little bit more, there's a little bit more flesh on the bones there. Anyway, I've spoken heaps, and I'm sick of my own voice, so I'm sure everyone watching is as well. So over to you, Azaria.
Perfect. Alrighty. So of course, insurance costs money, and when you pay for an insurance policy, you're paying a premium. That's what a premium means. So we're going to go through a little bit of information about premiums and how it all works. So the first thing, there's two different types of premiums when it comes to life insurances. So number one, there's something called step premiums. And what a step premium does is it's actually quite a bit cheaper when you take it out when you're younger. And then every year when you get older, that premium increases. So over time, your premiums will go up, but at the start, they're actually quite a bit cheaper. So you save some money in the early days, but you do end up paying more over time. Or there's something called a level premium. Now, a level premium, you pay a little bit more for it when you first take out the policy when you're younger, but the premium doesn't increase as you get older. So it stays relatively flat. So the benefit there is if you are, let's say, 30, you're young, you're healthy, you take out a level premium, you're kind of going to be continuing to pay the premium of a 30-year-old even when you're much older. So that's the benefit of the level premium. Now, there's no right or wrong answer. When we're looking at the best option for someone, it's going to be based often on their age. So the age that you're taking out the insurance can have a big impact on whether or not you'd go for a step premium or a level premium. But the easy way to remember it is stepped increases, so it goes up a step each year, and a level premium, it stays quite level. It doesn't increase with your age moving forward. So the two types of premiums. In terms of how you can pay for these insurances, so the type of cover that we look at, for example, with retail insurance, they're unrelated to your super fund. So you might have an Australian super fund and we recommend a policy with X insurer. You can actually still pay for some of these insurances through super. So for example, life, TPD and income protection, those can be paid for through your super fund. And as I said, they don't need to be provided by your super fund in order for you to do that. So this, number one, reduces the impact on your cash flow. If money is a little tight, I know that's the case for a lot of people right now. Maybe you don't want to be forking out a bunch of money for your insurance. That's fine. You can actually have your super balance pay for some of that. And another good thing about doing it that way is that the super fund actually claims a tax deduction on that premium, which means that you pay 15% less for that insurance. So that's the first way that you can pay for some of these insurances is through your super fund. The second part is paying for some of it through your cash flow, so either bank account or credit card. So you can pay for all of your insurance policies through cash flow if you like. There can be benefits to doing so either through super or through cash flow. Trauma insurance and child trauma, the ones that we've touched on so far, they have to be paid for through cash flow. And another good thing to keep in mind is income protection. When you pay for that one through cash flow, that premium actually becomes tax deductible. So there's different ways to structure these insurances that are more cost effective or more friendly for your budget. So have a chat to your advisor and they can talk you through the best way to structure those. And then the question that we always get asked, that's really, really hard to answer, is what will my premiums actually be? Short answer, I have absolutely no idea. I don't know you yet. We'd love to know you. So what we can do is we would be looking at a number of different factors when we're looking at your premiums. So what insurers do is they assess you based on your age. That's one of the first things that they'll look at. Your gender plays a small part as well. And then your occupation. So someone who sits at their desk all day like me and Phil and just types at a keyboard and speaks into a microphone, pretty low risk. It's pretty unlikely that anything bad is going to happen to us at work. So our premiums might be cheaper than someone who, for example, works in the mines and is underground a lot of the time and may be more exposed to risks in the workplace. So occupation does have a big impact on your premiums. Of course, how much your insurance you're applying for. If you apply for $1 million, it's going to cost more usually than $100,000 of life insurance. Also the features of the policies. So things like your waiting period on your income protection can really impact the premiums. The type of premium you chose, so we just touched on stepped and level premiums, of course, so that's going to have an impact on what you're paying. Some pre-existing medical conditions can impact your premiums as well. So, for example, if you have a what's an example? Maybe a diabetes, for example, then you may have a loading on your insurances. So you might pay slightly more than someone else in your position based on that. But again, have a chat to your advisor. They can kind of talk you through that. And then the last thing is just the insurance company that you're applying with. So some insurers for certain demographics are cheaper than others, and that can have an impact on your premiums as well. So my advice to anyone who is nervous about taking out insurance because they're scared of the premiums, again, just have a chat to your advisor. They can customize your levels of cover, the features and all of that kind of thing to your budget to make sure it's affordable. And as I mentioned, again, a lot of that can be paid for through super. So the amount that you have to pay for personally might actually not be much at all. Alrighty, so how to apply? I'm going to talk about the underwriting process. So you might have heard about something called underwriting. For a long time when I was in university, I always forgot what that word meant because it seems so weird. What are you writing under? Essentially what they're doing when they're underwriting is they're assessing your situation before they offer you an insurance policy. So As I mentioned, underwriting is how insurers assess the likelihood that someone will claim on their insurance. So they'll look at your health history, they'll look at if you smoke, what you do for work, what kind of things you get up to on the weekend if you're jumping out of planes, for example, and that will help them determine if they're going to apply exclusions. So they might exclude certain pre-existing conditions. They might load the premium. So if they think something might be higher risk, they might charge you slightly more for the insurance. Or in some more severe cases, they might decline certain covers entirely. They might not offer certain policies. So really important to go through this process early on. Now, in terms of the actual process that we go through, this kind of gives you a start to end overlook of how that works. So number one, you would submit your insurance application with your financial advisor after you've gone through the costs, the features, and what you're looking for. Second thing you do is complete a personal statement. So usually what this looks like is you'll have a maybe 30, 45-minute phone call with the insurance company. They're going to have a massive list of medical questions in front of them, which you're going to sit on the phone and answer. So that's ultimately what determines the outcome of your insurance application. Then what happens is the insurers take that information to their underwriters, and those underwriters will have a look at your history, your disclosures, and they'll use that to create essentially an offer of insurance. Number four, they'll make a decision there, and they'll let us or yourself know what the outcome is. And then number five, you receive your outcome. So once you're happy with everything, then we will click go, and then you'll be fully insured at that point. So it is a bit of a process. As Phil mentioned earlier on, it can take a little bit longer, but it's really important to do this at the start. Here's an example of why it's so important. So in this example, we're looking at someone who is 33 years old, and their mother at age 45 was diagnosed with breast cancer and made a full recovery. This might seem pretty straightforward. In our experience, the offer from different insurers could not be more different. So for example, we've removed the names, but insurer A, they would place a breast cancer exclusion on trauma, income protection, and TPD, meaning that that person, that 33-year-old, could not claim for breast cancer on those policies, which is a pretty big deal, especially if it's something that you're worried about being in your family history. Insurer B, they would either place an exclusion or they would place a 50% loading. So they may still cover you for the pre-existing condition of your mother, but they would charge you a higher premium due to the increased risk. Or insurer C, no exclusion, no loading, they're not worried about it at all. So massive difference between the different insurance companies, and that's why it's really important to get an understanding of what's out there. And the way that we do that for our clients is with pre-assessments. So essentially what a pre-assessment is once your advisor has your information, they can go to multiple different insurers and essentially say, hey, this is my client, this is their situation. If we were to apply for insurance with your company, what would the offer be? So for example, if you were to just go to your super fund and apply for insurance, you're really just hoping for the best there. You don't know what the outcome's going to be until you actually lodge that application. If they decline your insurance, then you've got that on your file. And then you kind of got to figure it out from there, what you're going to do next. So what we do is we look at multiple different insurers and we get an idea of what they're offering, and then we can help select an appropriate insurer that will either be, number one, the best price, or number two, have the best underwriting assessment. So just like that example before, the last thing that we'd want to do is blindly apply for insurance company A if they're going to exclude everything when there might have been an insurance company that would have given you a much better offer. So really, really important. The pre-assessments are a huge part of what we do. Alrighty, how to change the cover.
All right, so this is assuming you've already got cover in place. So there were a few people who already have cover and looking at reviewing. So there are really two options. You're either increasing the cover or increasing the risk for the insurance company. So you may not change the cover amounts, but if you're going from a 90-day waiting period on income protection to a 30-day waiting period, you're increasing the risk for the insurance company. So that'll generally require a full new application. And you need to undergo medical underwriting unless for very specific life events. So things like if you buy a house or get a mortgage, have kids, there are some life events that the insurance company will allow you to do a small increase on your cover without going through medical underwriting. And you may require additional financial advice. So if you set up your policy through a financial advisor, or you want help through the advisor, you may require additional advice. And that's just the beauty of our legislation around financial advice. Financial advisors helping you increase cover. There's a lot of restrictions around that. Now, decreasing cover is much easier. Now, it may not be the right thing for you, but it is much easier to do. So generally, easy online form to complete, or even just a signed letter to say, hey, I want to decrease from A to B. No underwriting required, because the insurance companies, from their point of view, you're going from $1 million worth of life insurance to $700,000. Well, they're going to pay you less. Sure, they'll decrease their premium, so they're making less money. But at the end of the day, they're going to pay you $300,000 less than they otherwise would. So happy days, they're happy to do that. So there is no underwriting required. But it's definitely really important to discuss the risk of decreasing your cover with your advisor, or just if you haven't set it up through an advisor, have a think about, like, do I need this in the future? There's plenty of things to focus on. And we are just about to release an article on our website about decreasing and the considerations of decreasing cover. Next is how to make a claim. So this is by far the most important thing in insurance. Hopefully no one, as I said at the top, no one ever needs to make a claim. That'd be ideal. But the purpose of these insurance is if you do get punched in the face in life, then you need to make a claim, and you need to go through that. You have to go through that process of a claim. So there's generally 3 different options to go through a claim. So you can always go directly. So if you've used an advisor in the past and you never want to speak to them again, then you don't need to go through them. We're not gatekeepers of your policy. Your policy, if we've set it up or any advisor has, is between you and the insurance company. So you can go to them directly. So anyone can do this if you're a policy holder. If you're not a policy holder, then don't call them up because you don't have a policy. And then you can contact the claims department. So you can start that claim yourself. And it can often be a bit more time consuming. Unfortunately, you don't know what you don't know. So you, not that an advisor or an advocate for claims is ever going to help you lie or massage. But sometimes, like, I get on the phone to our clients at the very beginning and just go through, just help them understand if there are any exclusions on the policy. So if someone calls me up and wants to claim on a mental health condition, I'll let them know if there's an exclusion on it. Hey, we may not be able to claim on that because there's an exclusion on the policy. So instead of going and getting the medical forms and doing all the claims form, if there's an exclusion and we can't make a claim, it's better to just have a chat about it at the very beginning. The other option is going through a financial advisor or a claims advocate. So your advisor can start the claim and manage it for you. So we do that on our clients' behalf. We'll always start the claim and assist them with that. And this can just take the stress out of dealing with a claim at stressful times. Now, it's not like we're not going to do everything on your behalf. We can't. We've got to get medical reports. Your doctor needs to sign off on stuff. So we can't just start and end the claim without your involvement or your doctor's involvement. But we just at least make the process much easier. The third option is going through a lawyer. Now, it's super duper expensive, and please do avoid if possible. Now, if you've gotten to the point where you need to make a complaint against that insurance company, I would still recommend either the financial advisor or a claims advocate before going to a lawyer, because lawyers will often charge like a percentage of the claim, and it can be really exorbitant sometimes. But that's still an option there. And it's still, plenty of people use lawyers to go to the claim. But often insurance companies, like when I talk to claims departments or head of claims, they often think this is actually a relatively straightforward claim that the insurance company are helping the client directly. They don't need a lawyer. They would have gotten to pay the claim, and they don't need to pay 30% of their TPD payment. So, Azaria, what do you need to prepare to see a financial advisor?
Yes, so I've got a bit of a list of things that your financial advisor might look at when considering your insurance needs. This is going to look really scary. I would say don't worry too much about all of this just yet. Often your advisor will, first of all, just want to have a quick call to go through your situation, in an overall context, and won't need all the details up front. But if you do choose to go ahead and go through the process, these are some of the things that might be looked at. So firstly, a huge part of the process, as we've discussed, is your medical history. That makes a massive impact on the insurance that might be available, cost, etc. So looking at your medical history, height and weight, medication, smoker status, if you've got any upcoming procedures like any surgeries, that needs to be considered as well. And also your family history. So this one might seem a bit baffling. How are you going to know what happened to your great grandma when she was a kid? Don't worry about that. It's just your immediate family. So if you've got, cancer in your family, if someone in the family had a heart attack, your siblings or your parents, then that will need to be disclosed. But beyond your immediate family, we're not worried about it all. Occupation, so wanting to know what you do for work, what your job title is, what your responsibilities are, how many hours do you work. As Phil mentioned earlier, that can have an impact on if income protection is available, for example. Qualifications, this can help get sometimes cheaper premiums if you're very highly qualified in your role. Looking at your income, and then also hazardous activities. So for example, if you're a firefighter or if you're doing a more risky job, then we'll need to know that as well. For example, even if you're working at heights. Now, financial details, we want to know a basic overview of your assets and liabilities. We want to know a little bit about your super. As you saw in those earlier calculations, we do consider that when we're looking at how much cover we think you need. And also just wanting to know about any future changes or goals in relation to your financial situation. So maybe you don't have a mortgage yet, but you're in the market and you're looking for one and you're expecting to have a mortgage in the next couple of years. That'll make an impact on what we recommend. Also, if you've got a pay rise coming up, then we probably want to consider that as well. And one of the last things is just your existing insurance. So a lot of you at the start said that you do currently have some insurance cover. We want to know about that. We want to know what types of cover you've got, how much cover you've got, the details such as the income protection waiting and benefit periods. We want to know how much you're paying for that insurance, and also if you have any exclusions or loadings on the policy. So as Phil mentioned at the start, a lot of those policies that you might get through super were just given to you automatically. You never answered any medical questions. If you did, we want to know about that so that we can make a fair comparison with other insurance products on the market. So that kind of gives you an idea of what to expect. The way we do it and the way other financial advisors might do it is there'd just be one big form for you to fill out to fill in that questionnaire once and for all, and then we can kind of take it from there.
Okay, so where to from here? So I'll kind of follow on from that as well. So and talk about our process and what we do and how we go about it. So our process is we only do insurance advice. So we're not going to make a recommendation on super or investments or anything like that. We just do insurance advice, and we love it and we geek out about it. But we just start off with a 15-minute phone call. Now, before that 15-minute phone call, you do not need to get any of that stuff, as Ari just touched on. We get a lot of people asking, I need to make sure everything's all my ducks are in a row before we get on that phone call. That's not the case. So we just get on the phone just to get an idea about yourself and give you an idea of who we are. And we just want to make sure that we are the right fit for each other. And then next, if you do choose to go ahead with getting advice, we call it an insurance proposal. So for us to do all that work, collect that information, do all the research with the insurance companies and the pre-assessments, we charge a fee. So we call it the proposal fee. And that's $330 for individuals and $495 for couples. And that's just a once-off cost for us to do all that work. And then we gather all that information on an online questionnaire. And that's when you need to start thinking about, okay, what information do I need? And start gathering that. But all of it's prompted. So we ask you all these questions and you answer it as best as your ability. The medical question is the most important. So as Azaria touched on before, talking about that family history of breast cancer. Now, in that scenario, if the mum was actually over 50, it'll open us up to more insurance companies. If the mum was actually over 60, it'll open us up to more, almost all insurance companies on the market who would offer cover without an exclusion. So that's why we ask a lot of those questions, because it really just gives us an understanding. It's really just a puzzle piece. Okay, someone with this medical condition, we know an insurance company is not going to like it, but they've also got this one. Okay, then it kind of, puts us into a position where we make a recommendation on the right insurance company based on those complexities. So, and if anything's missing out of what Azari touched on, if anything's missing, our team will reach out and say, hey, we actually need this because it impacts the advice. It'll impact which insurance company we recommend. So that's why sometimes there is a bit of back and forward, just so we can make sure we're giving the most appropriate advice. And then if and then we go through that insurance proposal via Zoom, online. And then we basically talk about the level of cover, how we think about it. We talk about exclusions or loadings, and we talk about the cost. Obviously, I liked what Azaria said before. We try and make it tax effective and cost friendly. I've never paid anything in my life where I thought that's cost friendly, but I really do like the way of calling it cost friendly. Cost is a thing when it comes to insurance, and it's just a matter of like partnering, what your requirements are and what your budget is with the level of cover that you feel is important. So we'll tell you what to spend on insurance, but we don't pay the bill. So you guys will determine what level of cover that's appropriate. And then if you do choose to go ahead, you may not choose to go ahead and say, hey, thanks for that. We're not going ahead with any of the cover. But if you do choose to go, then go ahead. We'll go through that insurance application process that Azaria touched on. So we are at the end of the presentation. That's been a lot of information, Insurance 101. I hope it's been really helpful in terms of understanding the lay of the land of how insurance works, because it's something that we don't talk about. Everyone gets car insurance and we understand it, like you buy it online, but life insurance and income protection, there's a huge level of underinsurance in Australia, and a lot of that is just because it's misunderstood and we don't actually understand what it actually covers and how it works. So I hope that's been helpful. Now we are going to go to the Q&As. We've got a whole bunch of questions in here. Azaria, can you see the questions?
Yes, I can. Yeah. Perfect. I might start with one, Phil.
There you go.
Awesome. So Joseph said, do you offer other financial advice, or just insurance-based advice? Great question. We are insurance specialists, so we're financial advisors that have just chosen to specialize in insurance. So we can look at super in the scope of how it relates to your insurance, but we wouldn't recommend, moving to a new super fund or taking out certain investments. We really just want to hone in on your insurance, and we can refer you to people that can help with all the other stuff that you might be looking for.
And we look at the insurance within your super fund. So we don't just like close our eyes and say, oh, let's pretend that's not there. We do look at that as a part of your overall insurance needs, but we won't say, hey, move from Australian super to ABC super fund or whatever it is. That's not a part of our advice. So I've got a question. Medical exclusions, do these expire? How long do they need to be declared? Can an underwritten policy be amended down the track to include an excluded condition after a period of time? 7 questions in there. Let me just go back and try and answer them all. So do they expire? No, they don't. So once the exclusion's set on the policy, it won't expire. So they don't say, oh, this is excluded for the next 5 years. But the question is, can it be amended down the track? The answer is yes. So today, when you apply for cover, you get an exclusion. Let's call it a back exclusion. And then over the next 3 to 5 years, you don't have any issues with your back. Then we can review that exclusion and go back to the insurance company and say, hey, we don't have there's been no issues with the back since the application or since the last 10 years. Can we look at getting that reviewed? And often underwriters will review the policy and remove that exclusion from the policy. And then the question of how long do medical issues need to be declared for? We ask pretty specific questions, like in the last 5 years or in the last 10 years. From our point of view as advisors, we want to know more information. The more info, the better. So a niggle that happened 10 years ago, just tell us and we'll let you know it doesn't impact the cover at all. So it's important just to declare as much as you can with us. We're not going to encourage you not to declare it, but insurance companies will have very specific timeframes. In the last 5 years, have you A, B, and Z?
Awesome. We've got another one here from Aisha. She said, hey, Phil and Azaria, what if I'm young, early 20s, single with no kids, no mortgage? What is the benefit of having life insurance policies at this age? Should I have my super default covers that kick in at 25, or should I get in touch with a financial advisor like yourself? So really great question. I'm going to be extremely biased. I took out my insurance when I was 19, so I really love insurance. I really believe in the value of it. But I think 100% take out your insurance while you're young. So right now, you're the youngest you'll ever be. probably you're the healthiest you'll ever be, as horrible as that is to think about. So this means that it's going to be quite affordable for you to get insurance now. You're going to have minimal, ideally, exclusions and loadings on that policy. And you can really lock that in and have that there for the long term. And we all know that unexpected health issues can happen at any time. So you really want to make sure that you're insured for those. Another thing I think about as well is being in my 20s myself, I've got a huge, long career ahead of me. I've got thousands and thousands of dollars that I'm going to earn, and I'm a long way from being self-funded in retirement. So if anything were to happen to me, if I were totally and permanently disabled, well, that's a lot of lost income, and I'm definitely not wanting to rely on family or the government to see me through that. So short answer is if you rely on your income to pay your bills, absolutely, you need insurance. Get in touch and we can help you out with that.
Yep. And I mean, we've got a client who's still kind of on partial claims, who claimed, I think, at 28 for long COVID. And it's been, almost 2 years. Well, we're coming up to like 18 months of being on and off claim for income protection. So that's a claim scenario. That's much less common. But also, it's just a matter of if a health issue happens when you're young, it may just have an exclusion on when you're older as well. So yeah, definitely echo Azaria's sentiment. I got my insurance when I was 24, I think, 24. But I was crazy in having a kid on the way, so it was a little bit different. All right, Chris is asking, would you change or adjust your income protection cover if your income level increases or even decreases based on your job change or taking a break from working? It's a great question. Income protection is the more complex of the insurance covers. The others are really fairly straightforward. If you've got $1 million of life cover, if you die, you get $1 million. Income protection has these clauses in it where it says that if you're not earning the level of income at the time of claim, then your income protection cover is covering, you won't get paid as much. So there are some nuances with the contracts. So if you take time for parental leave and you're out of the workforce for 12 months, insurance companies can look back at your prior parental leave income and assess it on that. But if your income is going to drop and not increase back up, it's generally it's a good idea to bring that level of cover down. But I had a chat with a client the other day who started his own business. He's wants to cancel his income protection. And my question to him was, do you think, because he's not taking an income from the business. And so I just asked, do you think your income is going to increase back to that level over the next few years? Because if it is, then you've got a policy with no exclusions, no loadings today, even though in a year's time, if you go on claim, you may not get paid. It still may be better to keep paying those premiums so you don't need to reapply for the cover. It is very nuanced in terms of whether it's right or whether it's wrong. Some of the older income protection policies, they've got a lot more grace. So if you're out of work for 2 years, you can still get paid your full income protection. But yeah, if you're increasing your income, if it's a significant increase, definitely increase the level of cover. If your job changes and you're decreasing income, have a chat to an advisor, and we'll just talk about the pros and cons and just empower you to make an informed decision.
Perfect. What are the other questions that we've got here? This one from Jen said, how often should I review my insurance cover if I'm getting some? So taking out the insurance is one thing, reviewing it is another. What we generally say is we don't have a time period. We don't say every 12 months you need to review your insurance, because your situation might not change that much in 12 months. So usually what we'll say is when you've had a big life change, that's the time to reach out to your advisor and make sure that your insurance is still suitable. So that could be you've taken out a mortgage, maybe you've paid off your mortgage. Congrats if that's the case. Maybe you've had a child, you're getting married, things like that. That's usually a really good trigger point to review your insurances, make sure you've got the right amount of cover. So we generally say when there's been a change, reach out, let us know. We can look into that for you.
Next question from Instagram. Don't understand how that works, but I'm too old. Should we get couples cover or separate policies for similar incomes as a couple? So with the policies, I was talking about a couple scenario in the webinar. Those policies are actually individual policies. So the insurance company will assess you both individually. And if something happens to you, on an individual basis, your own health, you get paid a claim. So I won't get paid any money if my wife, Kate, gets sick. It'll only be on her policy. So policies they're not linked together as couples. It's different to health insurance. So health insurance, you'll get like a family plan or an individual plan. Life insurance, they're all individual policies. But the way we think about the cover that's important and the level of cover will differ based on if you're single, no dependents, no debt, versus if you're a couple and you've got kids. There's a whole bunch of different nuances in terms of the level of cover we think is important.
Perfect. Another question we got from Justin said, can I retain my insurance despite having an inactive superannuation account? That's a really good question. We get a lot of people coming to us on the initial call. They'll say, yeah, I've got some cover in my super. We go to look in the super, there's no cover. It was cancelled a few years ago because maybe the account was inactive. So what you want to do is, if you do have insurance in your super fund and you do want to keep it, you want to make sure that that's active. Maybe that could be making some contributions to that super fund or opting in. So you can have the option often to go online, log into your super fund and say, hey, I want to keep these insurances even if I'm not making contributions to this super fund. So make sure you're on top of that. And again, I'd say have a chat to a financial advisor. Maybe you don't need to keep those insurances, maybe you do. So yeah, make sure you can find out what the best option for you will be.
All right, next question from Facebook community. I've heard someone say that income protection should be purchased outside of super, but I can't recall hearing the reasoning for it. I know that, so I'll start with that and I'll come back to the rest of the question. So we didn't touch on the nuances too much with income protection inside of super or outside of super, but there are some distinct differences between the policies. One of the big ones is if you, and it relates to this question because they're talking about in the middle of a job change, income protection, if you're not gainfully employed at the time in which you are injured or ill or sick, you won't get paid any income protection claim. You're not eligible because under superannuation legislation, it says that you're not employed, so therefore you shouldn't get income replaced because you don't have an income, even if that gap of time is a week or two. So that is one of the difficulties is having income protection inside of super. It is wrapped in a different part of the legislation under the Superannuation Industry Services Act. So that's one of the issues with having income protection inside of super alone. Now, retail cover, a lot of retail insurance companies, they kind of get the best of both worlds. I actually don't know how they do this, but they do. They give what's called free complimentary, clause in their contract that says even if you're not gainfully employed at the time of claim, they'll still pay out. Don't understand how they do it, but they do it. And so you can get the best of both worlds, or you just pay a really small portion of the premiums outside of super. So I'll go to the next question. I know that TBD and life insurance is within my super, and I'm in the early stages of changing a job and early stages of changing everything up. So my question would be, should you get all of the protection inside of super or should you get it all outside of super? What are the pros and cons? So lots of pros and cons. Tax, really the way of thinking about how to pay your premiums is the quality of the cover, but the two things that Azari said before, tax effectiveness and cost friendliness. So having premiums paid through your super, it's cost friendly because you're not paying it from your own personal cash flow. So when cash flow gets tight, you can still fund your premiums. And when cash flow eases up and you got more cash, you can put extra money into super to pay back that premium. So it's like a big bank account you can use, but making sure you keep paying that money back. Having some income protection outside of super is more tax effective. So it's just that balance. Definitely reach out to an advisor to talk about the pros and cons of all of those things. The other thing, tax effectiveness, is life insurance and disability can be tax deductible to a super fund, but it isn't if you pay it personally. Again, pretty complex. This is Insurance 101, so I won't go too much deeper. If I did.
Perfect. All right, we've got another question. Does the individual need to undergo a medical exam before their application? So this just depends. As Phil mentioned earlier, if you're applying for a really high level of cover, let's say you've got an income protection policy of over $10,000 a month that you want to apply for, then the insurers might at application stage ask you to go through a couple of medical checks. So that could be a quick check with a GP to go over height, weight, blood tests, urine tests, and things like that. If you are, pretty healthy, there's pretty low chance that you'll need to go to the doctor and do anything. If there are pre-existing conditions, then the insurer might request that. Often the insurer will actually cover the cost of those checks as well. So no need to do anything right now. Once you've lodged the application, the insurance company will kind of guide you on what information they might need to know. So sit tight until that application happens and we can better guide you on that.
All right, next question from Matt that went away because I think
Sorry, I finished answering.
all right, I'm young and healthy. Do I really need trauma cover? No, I'm going to say this in a different way. I'm young and healthy. Do I really need trauma cover now? Or can I just take it out when I'm older? Did I do that well, Azaria, or am I?
Is that what you said?
That's what my girls sound like. I got like pre-teenagers. It's definitely what they sound like. So, do you need insurance or trauma cover when you're younger? Yeah, definitely. The equation is I'm less likely to claim on it, but it also means it's cheaper to take out. If you're considering level premiums, it's even the equation to take it out earlier is even more in the case of yes, definitely do it. So the likelihood of you having cancer or strokes or heart attack is very low. But if it does happen and you have a long battle with any of these things, then it's really significant. And so my recommendation is definitely, but it's a cost consideration, and it's just always having that balance between cost and if something was to happen, I want protection. So for me, I've got car insurance, and our car's worth probably less than $2,000. But I've still got car insurance that cost me $1,200 for it. Now, really, do I need it? No. But the reason I have it is because if I crash into someone else's car, it's going to cost me $50,000 that I don't just have, and I can't pull that out of the bank account. So yes, trauma is low likelihood of happening, but it's still really important in my mind for young for young people. And when you're young, it's really is super cheap.
Yeah, definitely. Alrighty, got another question here. For self-employed individuals, what does the underwriting / pre-assessment process look like? So if you're self-employed, in most cases, you can certainly still get life insurance, income protection insurance, and things like that. There will be a little bit more in terms of requirements at the early stages. So the insurer will want to make sure that you are actually earning the income that you say you are, as opposed to potentially taking your word for it if you're employed. So they might want to see some tax documents that you maybe have over the last few years. We'll ask for things like a profit and loss statement. But in the initial stage, if you choose to go through us, for example, we kind of give you a list of things that we'll need from you, and we can guide you through that process. So it can be a little bit more difficult, but we can help you out there.
Awesome. Well, that is all the... Wait, is that all the question? No. Got another question. What's the difference between life insurance and income protection insurance? My super has income protection insurance. Do I need to get my own income protection insurance as well? Do I need to also get life insurance? So life insurance and income protection, they're different policies. Life insurance, you're dead, you get money paid out as a lump sum, and it doesn't go to you because you're dead. It goes to someone else who you nominate. Income protection, the money goes straight to you. I can't earn an income because I'm injured, ill, or sick. I'll get paid a percentage of my income replaced, so 70% of that income. So they really do fulfill very different needs for insurance. And so if your super has income protection, definitely check the level of cover and the benefit period. They're the two things that are often very low if you have it within super. People, it's in their super statement. Who cares? I can't be bothered reading it. But it's important if you ever need to claim. So most default levels of cover is really, really low. Like some of the best levels of cover is like $2,600 per month. And based on the average Australian income, that's still incredibly underinsured. And that's some of the best default cover. The benefit period is often capped out at 2 years on a default level of cover. And so it means you only get paid for 2 years, as Azaria touched on earlier. So it's don't go and cancel it and then come and have a chat to us at Skye. Keep it and let us review it, because sometimes it's a matter of going, that insurance we don't love, but it'll form a really important part of your insurance needs. So that'll help protect a portion of it. But if this new cover is going to get you an exclusion for a back, but this old cover's including your back, well, let's just bring them all together. It's kind of like a puzzle piece, the way we work, in terms of based on your medical history and based on kind of the level of cover you need and based on what you've got. We just try and piece those puzzle pieces together. We piece the puzzle pieces together. Here we go.
Yeah.
Nailed it. Okay, cool. I don't think I did, but appreciate it. All right, that's all the questions we've got. Now, before we end, we do love doing webinars. We're doing one in November on insurance claims. So we do have a client of ours and a really good friend of mine who's currently going through a claim. He's currently having chemo treatment. So hopefully, depending on the week his chemo is, hopefully he can join us for that webinar. But we're going to talk about like insights into insurance claims, because at the end of the day, hopefully we never need it, but that's the whole purpose of paying these premiums. So I hope Jace can come to that webinar and be alongside. But me and Trent, another advisor in the team, are going to do a webinar in November. So definitely jump on and join that. If you're watching this recording after November, then I'm sure that recording will be up. The other thing is we love feedback. So good, bad, indifferent. We just love hearing what people think of these webinars. We put a lot of work into them. I think they look great. Our team do an amazing job. It's definitely not me designing these webinars, but we just want to make them as valuable as possible. So we'd love to hear your feedback on how you found it. Even if, Phil needs to cut his hair is the feedback, it's all very much welcome and true. So we'd love to hear your feedback. And before we finish, thanks heaps to Azaria for doing almost all the work.
Thank you, Phil.
For the webinar.
No, thank you. It's been great. And if you guys have any questions after watching this, as Phil said earlier on, send us through an email, book in a call. More than happy to have a chat about your situation and if we can help.
Awesome. Thanks heaps, everyone. Have a good night.